In the last lecture on Principles of Accounting, we looked at break-even analysis. Now, we made the point that in the increasingly automated world we live in, costs are getting more and more fixed. But nevertheless, businessmen want some recognizable division of costs rather than just to see cost as one amorphous big lump. And so what we try to do in costing is to get some idea of what we call the full cost of a product or a service. And this involves allocating costs that are really fixed over the short term, allocating them to the activities that they represent, and then working out some sort of approximate cost of a unit based on a certain level of production. So whatever the cost makeup, if we produce 1,000 units and our total costs, whether fixed or variable, come to £2,000, then it's £2 a unit, right? So as a very approximate measure, it allocates our costs to the number of units, and that is the essence of full costing. But we must be aware that there is aware, I suppose, of the term cost. It's not being used in the normal sense that we would understand it, in the sense that well, we talked about 1,000 units. If we made 900 units, our costs would not go down by 100 times our full cost per unit, because a lot of those costs are fixed. So in that sense, it's not a cost that we spend every time we make a unit. It is an allocation of costs to give us a rough idea as to whether the price per unit that we're charging is going to cover our total costs, and obviously that's surrounded by quantity assumptions. Here are the learning outcomes. So why do we want this full cost? I've already said that it's not exactly a kind of expenditure type cost, but it's nevertheless useful for these particular activities, assessing, are we getting better, are we producing more for the same level of fixed costs? We could call that efficiency. Control is a very important feature. Fixed costs, as they're not related to the product, there's a danger that they can just escalate as people invent more and more costs in order to make the product, these costs being somehow essential. And a lot of money is wasted in business. In retrospect, you see, oh, well, we needn't have spent money on that, we needn't have spent money on that. Well, perhaps the money was spent because there was a lack of control. Assessing performance, well, it can indicate how efficiently we're working, especially if we can compare it with other companies. And pricing out and output decisions, well, that is a little bit of a difficult one. But it will give us a rough idea. Clearly, if we are producing it well below our if we're selling it well below our full cost, then clearly there's something amiss. Just as a little aside, I say at a number of points, well, it's approximate, it's good enough, and things like that. And many people think accounting is all about being precise, and in certain aspects it is. In double entry, for example, if it's out by a penny, then it doesn't balance. But essentially accuracy is always really in relation to its use. That is what determines accuracy. There's no absolute level of accuracy. So, for example, if we're looking at your height, you may measure it to the nearest half inch or centimetre, whatever you want. But there's no point in measuring it to, say, 10 decimal places. That would be ridiculous. But equally, at the other end, we have figures in business, accounting figures, that are an approximation but are sufficiently accurate for the decision that needs to be taken, and that trying to be more accurate, as it were, really just means providing details that are not needed, and not necessarily helping the decision, because it's important to understand that many figures are indeed approximate figures, and they're not accurate necessarily for what they're trying to represent. Okay, so here we have pictures just emphasizing the production process, and you can see that there are varying degrees of human involvement. I think that one looks to be the most intensive. That one is also pretty intensive. I've audited in a factory that was like that, building reconnaissance aircraft, the RAF. Then we have the vehicle production line, and all these people have been replaced by robots. Rather sobering thought. And of course we have computers now, computer-controlled lathes, replacing men who would often see being accurate on the lathe was an art. Anyway, let's not dwell too much on that. Another classification of costs that's going to be relevant to us, we've got direct costs and indirect costs. Direct costs tend to be variable, but they're costs that can be identified with specific cost units. Indirect costs or overheads that are not particular to any individual unit of output. So we've had fixed and variable before, but the same idea tends to have different words in different contexts, and possibly with slightly different meanings. So direct cost is similar to our variable cost. This is similar to our fixed cost, fixed in relation to output. It's not that these costs never change. So generally you can see here, as you might expect, that service industries have a lot of indirect costs as a percentage of their total costs. Manufacturing have more direct costs. They're producing a product, and it's the cost of the product that is the main element in the overall cost. Here it's the service cost. A lot of it is labour, which tends to be fixed, certainly over the short to medium term. And this is for the UK, which is nothing more than the particular mix of service and manufacturing in the UK. So that's something to remember as to the basic structure that we have in business. The full cost of a job is the direct cost of the job, and then these words, the appropriate share of indirect costs. And it's this word appropriate that we need to focus in on. What is the appropriate share? What burden should it use? And that's going to involve fixed costs to be allocated to the full cost, and variable cost to the full cost of the product, or indeed the service. So we have our fixed and our variable costs tend to be the indirect and direct costs respectively, and together they make up the total cost for a particular job. Here we have a particular example making a sale as a job cost. So we want to know, I think this is marine supplies, so it's a sale to a sailing boat. Right, so we work out the total overheads for the company, derive a suitable rate to charge out, and this is the traditional way, charge out to as a whole for the business. The traditional way, well, it's called traditional, it wasn't always like that, but we won't go into those details. So we look at an absorption rate. Often it's per labour hour. You get this with garage bills, or you used to. I don't think they break them down like that, but you'd see that the charge on the garage bill would be like £100 an hour, and you think, oh goodness me, that guy's getting £100 an hour just for fixing my car. No, he isn't. It's got a lot of the overheads added on that the charging out £100 must cover not only his wages, but also the rent, rates, management, etc., etc. So that's the overhead rate, as I said, charged out often on labour hour. And then we've got to apply this overhead rate based on the specific usage of, in this case, direct labour hours. So how many labour hours that it takes to make a sale will determine the share of fixed overheads that it takes up. Then to this we add our direct labour costs. Sorry, I was interrupted there. So we've got the direct labour here, we've got the direct materials, and also we've got the overheads being charged. And in this day and age, the overheads can be the major cost. So the way in which overheads are allocated becomes crucial to the way the business is being run. So these are very important factors. So clearly, if overheads are being piled on labour hours, then you're going to be giving low costs to products that don't use much labour, but they may be still costing quite a few fixed overheads, and this is the problem that business faces, because it is just a very approximate method, and in this case too approximate for many of the uses. Let's just focus in on this allocation of costs. So we've got total costs for next month of 20,000. Direct labour hour basis. It's example 8.2. We haven't got any details here, but direct labour hours for job 1 and job 2, they both use the same level of labour, and therefore the costs, the 20,000, is split equally between them. But if we do it on a machine hour basis, it may be that job 1 takes 14, what's that, to 28%, is it? So, hang on, it's more than 28%, it's 70%. So if it takes 70% of the total machine hours, and job 2 only takes less, if the overhead costs are allocated on a machine hour basis, then job 1 is going to apparently cost a lot more than job 2. And that's the problem. You can see the difference in the allocation, 10,000 to 14,000 and 10,000 to 6,000. So this £4,000 movement is a major movement in the costs, and it can distort the decision-making process. So we want to try to divide our overheads up into greater detail, because our general approach was really a little bit too vague. And one way is to divide it into departments. So we get the total costs for each department, and these may be charged out at different rates. And this is the process of going into a little bit more detail. And we divide it into departments, the size of the costs, break it down, the complexity of the procedures, expertise. It's can get a bit lost in the process. So if you've got a particularly valuable overhead resource that's being used on certain products, then perhaps you want to single out that fixed cost. And then accountability, it helps to charge out costs to products, because then people kind of look at a cost and say, well, that's a major part of our overall costing, and is this an efficient expenditure that we're making? So allocating overhead costs is a way of controlling overheads by hardwiring them to the end product. So we have here a job A passing through various departments: preparation department, paint shop, finishing, and then out to the customer. And we've got direct materials, direct labour, and a share of the department's overheads on whatever basis they choose, and any further direct costs, and a share of the overheads there, and any further direct costs and a share of the overheads here. And it can all be shared out on different bases. And that brings us to the full cost of the job. It is quite an expensive process to have a system like this, but job A, as it were, goes through each department, picking up the direct costs and the allocated overhead costs. And this means that there's slightly more control over the overheads as they're treated in greater detail. So how many cost centres do businesses have? We have UK businesses, percentage 36%, with more than 20 cost centres. So, that's a lot of cost centres. The product doesn't necessarily go through every cost centre. And then a sizable number with 11 to 20, and then fewer and fewer. So having a cost centre, that is a cost associated with, these are also called cost centres. Having a cost centre is a very common feature of costing systems. Now, there are various processes that are involved. There are continuous processes, there are job costs that we've looked at already, and there are also batch costs. So with batch costs, a factory would be, say, making whatever product is in units of 500 units at a time, and that would be a batch. It may be, tons of, pounds of some chemical or whatever, but they're made in batches. So the full cost of a batch using a job costing basis, as we've looked at here, that's a particular job. So that can be one whole batch. Then divide that by the number of units in the batch, and that gives us a full cost of 1 unit in the batch. So we can adapt our method to the different processes. Costing and pricing in the traditional way, we have our direct, labour-intensive paste production. Remember, we've characterised the traditional way as being a low level of fixed costs. So we've got a low level of indirect costs relative to direct costs. We're not highly computerised. And this, exists today in service industries, in particular. Sorry, not in service industries, but in cottage industries. Small industries may be making things by hand. So there can be a low level of fixed costs and a relatively uncompetitive market, and that's how we characterise the past. In the new environment, we've been emphasising that it is capital-intensive, machine-paced production, high level of overheads, and highly competitive markets. And we saw the effect on break-even analysis of this environment, how it made it a far riskier environment. So, what do we have here? We have something called activity-based costing. And here we try to take hold of these fixed costs and say, well, they do vary with something. So we're going to break down each cost into its individual activities and work out how much it costs. Now, I was listening to a presentation of how Tesco did things, and he was looking at the cost of a particular product, and he said that one of the costs they included was the amount of space that the product took up on the till roll, right? When you get the till roll itemizing all the things you've purchased, one product is taking up one little bit of paper. He said that cost was included, which I thought was quite funny. So we take a fixed cost and we break it down into all its activities, all the different activities and effects that we can think of. So each support activity involved in making the product, so one was the till roll, apparently, the costs attributed to each activity. So, you know, if fixed cost is attributed to an activity, then we can work out the cost of that activity, because the cost varies with that activity. The factors that cause a change in these costs are the cost drivers. So any change in that is going to affect our fixed costs, and that's going to, if a product uses any element of the cost driver, then it's going to change our fixed costs. That's the idea. And so it's an attempt to try to make a fixed cost as variable as possible. So attributing overheads, we've got to divide our overheads into the activities, and we establish a cost pool, as it's called, for each activity. What costs are involved in the activity, allocate the cost of each. We'll have an example in a bit, I think. Allocate the total cost to its relevant cost pool. So we split up our total costs, and then we charge out in the costs in each pool according to what is making those costs change and the usage of the product in that cost driver. So obviously a product does use up a little bit of till roll. This, as it's, we've got this word accurate, which I always sort of kind of pause about, provides a more accurate cost for each unit of product or service. Well, okay, we'll have to accept that. Provides managers with a better understanding of the business. That is certainly the case. It looks at what benefits we're supposed to be getting from the fixed costs, and that can be very questionable, and what are the cost of those benefits. So in that respect, ABC costing is extremely useful. Here is our example as a schema. In your seminar you will have an example to work through. So we've got overheads are first assigned to cost centres. We've looked at that process. And then overheads are allocated out using an overhead recovery rate, and that was the example we looked at earlier, and this is the traditional approach. So we saw this when we were looking at job A and seeing how it went through the various departments. Now we have the ABC approach, and instead of product cost centres, we've got activity cost pools. So a particular department might be involved in a number of different activities, and say the accounting department would be involved in invoicing, so that would be one cost. It would be involved in processing the management accounting for the particular product. That would be a different cost. So each department will be involved in a number of activities, so it can get very complicated. I mean, we've expanded it from 3 cost centres to 4 cost pools, but in practice it would mean it would be many more cost pools. Then for each cost pool, what is the thing that is making the costs change? And so, we took accounting and invoicing. Some products may need several different invoices for whatever reason. Others may need just one invoice. And so we can have something, a cost per invoice. So something that uses up a lot of invoices, every item must be invoiced separately, is going to get a higher charge than something that is invoiced because it's sold in batches. The invoice per unit is far less. So that's our activity cost driver. And for each cost pool, there's going to be a different driver, and you'll be reviewing this in your seminar. Okay, so that was perhaps rather a brief look, but it's the concept that one must be clear about, and really it helps to look at an actual example, and as I said, your seminar will cover that. So ABC in practice, we can see that manufacturing with quite a high element of variable cost aren't so worried about it. Retail, where a lot of the cost is the purchase cost of the item, is bought and sold and a margin put on. Service industry, there are higher levels of fixed costs in service industry. And then the finance industry, I don't know what they mean by commercial sector. I think we'd have to go to the original paper to find that out, but certainly finance is part of the service industry, and I think we can say more generally that service industries with high levels of fixed costs are very keen, or much keener, shall we say, on ABC in practice, simply because their fixed costs are a higher element of their total costs. So for a business with a lot of indirect costs, fixed costs, allocating out these fixed costs to get some idea as to the cost of a particular service is potentially a good idea if the data is used intelligently. And for decision making, that can be problematic because it's not an allocated cost is not a true cost of the particular activity. In other words, if we produce less of one product, our fixed costs do not reduce, even though it's part of the full cost. So there's that tension there that I'm afraid many businessmen who've not had a proper course in business make the mistake of confusing. They say, well, it's a cost of the unit, so if we produce less, we're going to be saving ourselves the cost. Well, you're not, and that's very hard to explain. I've had that problem explaining to a director who was a graduate in biology from Oxford. I learned how to describe things in terms of trees and leaves and things like that. Anyway, that's an aside. So the use of full cost information, large firms use it more than small firms. Why is that? Because the levels of communication are more distant in large companies. They need a system to monitor, more so than small companies where the senior management know what's going on in the company. There aren't that many employees. They can go round and talk to them. They will know them personally. They will know what's going on and what the problem is. When it's a large company with over 10,000 employees, the directors and the senior management cannot go round and see what's happening for themselves. They need the system to tell them that. And that's why something like ABC costing, breaking things down into the various activities, is important in the control process. and it's just a reminder that we're talking about sharing costs rather than costs actually incurred. If you do not make the product, you do not save all the cost, and that is a lesson that many managers don't learn to the cost of the companies concerned. Okay, so that's it. So I would urge you to go to the seminar. Let's have a quick look at it. Here we calculate, we have a particular scenario, and you're asked to calculate the full cost and selling price determined by the traditional method and the activity-based costing method. What are the implications of the two systems, and the options exist for the business information. So that's a detailed question about some aspect of the question itself, the scenario. If you find it difficult and you say, "Oh, I don't understand it," go along to the seminar, and it'll make it clear. Remember, you're not necessarily going to have to answer a detailed question like this, but the question you may be asked may be much more basic about ABC costing, but it helps to go into the detail, because the more you understand the detail, the more, if you're asked a general question, you can say, "Oh, well, I understand the general bit. Yeah, I understand that." And that's because you've gone into the detail. It's a way of understanding the more general issues. So don't be put off if it doesn't fall into place immediately and seem straightforward. Don't panic or anything like that. Keep calm and understand what you can of it. And it may well be that the question you're asked is just a very simple question about the process, but it's important that you have a go at the process, at actually working it out. Right, okay, so do attend the seminar.